Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Great Eagle H interim report. Great Eagle Holdings Limited offers a diverse range of businesses and services across various sectors. Some of the key areas include property development, investment, and leasing, hotel operation and management under brands such as the Langham, Cordy's, and Eaton real estate investment, trust management, workspace operation, and property agency services, flexible property management and maintenance, secretarial and staff services, computer system and project management services, treasury management and investment fund management, procurement and financing services, hospitality and hotel management services, property sales and building material sales, beauty store operations. These businesses and services are operated through various segments, including hotel operation, property investment, property development, other operations, Champion REIT, Langham, and U.S. Real Estate Fund. The recent surge in Great Eagle Holdings stock price can be attributed to a combination of factors. A renewed optimism in key property markets and confidence in the company's diversification strategy have contributed significantly to its growth. Additionally, investors are increasingly seeking value-oriented picks, which has led to an increased appetite for the company's shares. Furthermore, analysis suggests that Great Eagle Holdings is undervalued, with a fair value estimate exceeding its current share price. The attractive valuation based on its price-to-sales ratio compared to industry peers also supports this trend. Overall, these factors have collectively driven the 37.6% increase in the stock price over the past year. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth drivers. Core business growth plus 5.5%, strong performance from property sales and rental income, capital inflows from high-end investment migration schemes, resilience in residential market due to talent acquisition schemes and visa students from mainland China, completed development and accumulated sales revenue decline drivers. Statutory accounting principles, minus 2.4%, decline in management fee income and distribution, income from Champion REIT, trade tensions between U.S. and China, affecting domestic consumption and Hong Kong economy, persistent trade disruptions, leading to supply chain issues, uncertain market conditions and escalating development costs. Net income and profit margins. A tale of two trends. The financial summary reveals a mixed bag for net income and profit margins. On one hand, the company's net income decreased by 18.8% in 2025 compared to 2024, but then increased by 7.2% in the subsequent period. However, this growth was short-lived as it declined again by 18.8%. The only consistent trend is a slight increase of 0.9% from HK $57.9 million in 2024 to HK $58.4 million in 2025. Profit margins also experienced fluctuations. They decreased by 17.2% from 19.4% in 2024 to 15.1% in 2025, primarily due to a 12.5% decrease in operating income from core business. However, the net rental income from investment properties increased by 6.6%, and profit margins remained stable due to a slight increase in operating income from other business segments. The decline in profit margins can be attributed to ongoing rise in operating costs and decreased average net passing rent despite increased occupancy. The company's financial performance is expected to face challenges due to global macroeconomic and geopolitical uncertainties, which may lead to further declines in net income and profit margins. The company is generating positive operating cash flow, indicating a strong financial position. The data on pages 56 and 60 supports this conclusion, showing an operating cash flow of $866,692 and net cash from operating activities of $314,779 in 2025, respectively. These figures demonstrate the company's ability to generate sufficient cash from its operations to meet its financial obligations. The company's debt levels and interest expenses have undergone significant changes over the past year. Debt levels. While there are mixed signals, a closer look reveals that the overall trend is a decrease in debt levels. Consolidated net borrowings decreased from HK $31,978 million to HK $17,935 million, and outstanding gross debts as of 30 June 2025 also saw a decline by HK $1,758 million or 11%. However, total debt level increased by 12.6% due to an increase in current liabilities. and total debt has only slightly increased from HK$28.02 billion to HK$28.07 billion. Interest expenses. On the other hand, interest expenses have decreased significantly. Finance costs have dropped by 23.8%, from HK$180,066 in 2024 to HK$669,763 in 2025. This reduction is likely due to a decrease in finance costs and lower interest rates, as evidenced by the interest rate swaps, which showed an increase of $96,887 unaudited, compared to HK$15,876 audited. The financial performance of the company can be summarized as follows. In terms of well-performing regions or segments, the hotel operation and property development sectors stood out. Specifically, Champion REIT's Langham operations and its U.S. real estate fund saw significant growth due to rental income from 3 hotel properties. On the other hand, certain areas underperformed. The company's property investment segment incurred a loss of $1,566,484 before tax, while other operations also reported a loss of $3,395 before tax. Additionally, Champion REIT itself experienced a loss of $1,100,737. Management's outlook on company strategy. The company is shifting its focus towards distributions, with an interim distribution declared for the first half of 2025. This change in strategy aims to better reflect the financial return and economic interest attributable to investors' investment in LHI. Management also expects strong performances from Hong Kong hotels, as seen in the 2025 interim results announcement. Furthermore, they anticipate collecting repayments from joint ventures within a year after the reporting period ends. The company has made significant investments through acquisitions to expand its portfolio. Key acquisitions include the ONTOLO project, joint ventures in Hong Kong's Kai Tak and Ma Tau Chung areas, residential units in prime locations, office space in Central, a prime building in Central for long-term investment, and several redevelopment projects in Japan, Canada, and Europe. Additionally, the company acquired ONMANTIN and 2 new outlets of Ying Flow in Wuhan and Nanjing. On the other hand, the company has also divested certain assets to optimize its portfolio. Notable divestitures include the Seattle Development Project, 1931 2nd Avenue, and the San Francisco Hotel Development Project, 1125 Market Street, and 555 Howard Street. The company has a history of paying out dividends to its shareholders. In 2024, it declared a final dividend of HK$50 per ordinary share and an interim dividend of HK$41 per share. The total amount paid out in dividends for both years was HK$373,862, indicating a commitment to returning value to its investors through regular dividend payments. Concerns about inventory buildup. A review of the financial summary reveals concerns about inventory buildup. The issue is explicitly mentioned on multiple occasions, indicating a potential problem for the company. Specifically, pages 12 and 56 note inventory buildup. Yes, highlighting the issue's significance. Furthermore, page 70 provides specific figures under hotel operation and other operations categories, totaling HK$376,037 unaudited, which is an increase of $105. These findings suggest that inventory buildup is a pressing concern for the company, warranting further investigation and action to mitigate its impact on operations. That concludes the financial summary. For Great Eagle H, feel free to comment below, and I will be happy to answer them when possible.